if the CEO is not great at it, then you need to have an investor board member around the table who knows how to also keep other investors productive, but also in line a little bit, so you don't waste time on things that don't matter. Words matter, what you say, but also how you say it and when you say it is one of the hardest things about early stage companies in particular, but certainly carries through all the way to later stage where you have more money, more ego, more voices around the table.
Nick Adams is an early stage investor
focused on fast growth software
and AI companies.
If you only focus on the milestones, or if you don't take a little bit of time to celebrate the wins along the way, then you're probably not enjoying the journey.
Welcome back to Decoded. My name's Alfie Whattam, and this is the show where I speak to experts about what it takes to build great teams and companies. Make sure that you click the follow or subscribe button for more great content like this, and I hope you enjoyed the episode. So, Nick, you've backed so many exciting software and AI companies. So what are you looking for when you're deciding to invest in a startup?
Well, there's the basics, right? We're seed stage investors, so we're always looking at sort of the bullet points of product, market, and team, of course. There aren't a whole lot of financials usually to go on and traction to point to in the early days of an AI or data infrastructure startup. So we've got to dig deeper, and there's a few things that we look to get to that are a little harder to measure, but are oftentimes the game changer. So I'd say, market timing is one of the assessments we have to make, and is really hard in the kind of market bucket. You can sort of do a TAM or every other type of sizing analysis, but why is now the right time? Takes a lot more thinking and analysis, right? Being early, being late is as good as being wrong in the venture world. So we spend a good amount of time trying to understand that. And then, most of it, I'd say, comes down to softer things about the team. We really value action-oriented founders, the ones that can, not just make a great Excel spreadsheet, but actually bring it to life with resources and humans and assets to get stuff done. Is we found to be probably the number one attribute we need to find in founders, especially at the seed stage, when you're kind of in that, wartime CEO mode where every day is a new battle. Kind of have to be that type. Later on, that doesn't always work as well, but early on, it's key. Then I would say, secondly, is we're always kind of looking for arbitrage. At seed, it's certainly, product, market, team, and all of that, but we're also trying to find a way that either the founding team and or our own network can help our company get to customers and places they might not be able to get to otherwise, right?
Okay.
If we can, get to the top of what an executive at Oracle or Salesforce or American Express is thinking about, that's an advantage and key for getting those early pilots and customers. So best that come from the founding team, obviously, because those are their personal relationships, but we naturally bring our connections and networks to the table as well. And then I'd say the last thing is, why is the founder doing it? Starting any startup, as you know, is like a crazy thing to do. It is not all up and to the right. The challenges, change over time, but they never go away. And I think, the big thing is understanding, when things aren't going great and you're running out of money and, your team is having issues and, the customers are pushing back on things, why do you keep going? So that part is really important. And I've learned a lot in that area over meeting thousands of founders and investing in, close to 100 of them and being an operator myself. So that's the most interesting part to kind of learn about people.
Okay, I love that you gave many, many different strings I can pull up there. You've already elaborated on a few of them. So the why, the motivation, obviously that's critical. Ideally, a business where you can help with the go-to-market, make introductions, that's key. The team, the high agency people, the mindset. I get that. And then the market, the why now, like something that only is uniquely possible in today's market, and there's a limited window of opportunity where you can strike. You mentioned product at the start, but you didn't quite elaborate on that one. Is there anything specific there that you're looking for? I mean, at seed, it's super early. There might be a V1, or maybe even earlier. It might just be a prototype or something. But like, what is it specifically in the product that you're looking at? Is it like, are you looking at particular verticals, or is it just something more holistically? Like, what's your view there?
It depends on a couple of things. So the way we invest, so our overall thesis is we invest at the application layer of AI, which spans pretty much every vertical. We tend to, because we're a little bit of LLM and Gen AI skeptics in a lot of ways, we tend to find ourselves investing around more predictive models, which brings us into usually harder industries and use cases. So we do a lot around financial services, manufacturing, supply chain, even HR and hiring to some extent, where explainability is very important. So I think that's an important context. But we also invest at kind of data infrastructure and deeper, compute, privacy, other supporting things you need to have in place. And the reality is the readiness of products is usually a little bit different based on when we're investing. If we're doing a core seed investment, usually at the application layer, there's some level of customer traction through, at least POCs, usually a little bit of repeatability, potentially even like a cycle of, churned or renewed customers. And we have roughly an idea who the ICP will be for the foreseeable future. Mm-hmm. Now, the challenge, I think, at the application layer is figuring out, does this initial use case get the company to 2 million in ARR or 20 million or 200 million, right? Before we have to start thinking about expanding that horizon to get to, venture scale type companies. As you go deeper down the tech stack, the problem is the exact opposite, right? Usually when we invest, there's a little bit less built out, and the initial traction is usually a bit earlier, probably a couple of POCs. The great thing about investing deeper down the stack is once you get to scale, the world is kind of your oyster. You can sell into pretty much any vertical. The hard part is finding those initial use cases, customers, early adopters as quickly as possible, and finding success with those, so that in a time frame where you don't run out of money, wasting time on the wrong type of customer. That part's super hard, especially at the seed stage. So, we're trying to solve for those different issues depending on where it is in the tech stack and just in the stage of the company that we're investing in. So, for us, the readiness means some slightly different things depending on, where we're investing in the tech stack. But yeah, it's usually MVP, initial product deployed. Not quite, I tend to say we like to invest at the point of commercialization. So we're not quite at the R&D side of things. So usually ready to go.
Okay, so like you've invested in hundreds of startups. You've met thousands of them. Like, what's a common mistake that every new founder should avoid? You must see trends and things that come up time and time again. Like, what are a couple of things that people listening to this show should try to avoid? I'm sure they'll still make the mistakes anyway, but try and save a few people here.
Yeah, we all do. It's inevitable. The key is to try to not make the mistakes that take you into the ditch, right? So within the guardrails, I guess. I think the number one thing I see with a lot of first time founders is being overly sensitive to dilution in the first real institutional round of funding. Obviously, ownership is really important. The difference between a $3 million round and a $4 million round when it's your first round of financing is potentially a difference between life and death. It's a difference between being able to absorb an initial misstep with product or team or go-to-market strategy, right? We don't always get it right the first time around, and having a little bit of buffer to absorb that and make an adjustment goes a long way. And I think what a lot of first time founders, early stage founders, don't always understand yet, because they haven't been through it, is that as you go through your journey and you're successful, and you're still doing a good job and still the person for the role and so forth, your future investors and board are going to make sure that you are very well incentivized to stay active and be involved in the company. There's far more value in the right people, in the right operators and the right executives having enough ownership relative to some of your other investors, right? Sure. So there will be incentives put in place. Making a little bit of trade-off on a couple of points at the seed stage is not going to make a difference when you're getting ready for your IPO or a huge M&A. For earlier on, the smaller outcomes, of course, there are different things that you can do to get topped up, but usually that's kind of marginal and around the edges. So I would just say, your number one job as CEO is don't run out of money. And if there are things you can do in the early stages, if the money's available to you to take a little bit more than your round size, even if it means a little bit more dilution, do it. You won't regret an extra $500,000, $1 million when you're, getting down to the wire on your runway.
Yeah, it makes sense logically. The more capital you have, the more runway you can have, and then the more shots at the goal you have, and the more time you have to find product market fit. And ultimately, that's the whole point of seed. Try and get, and even just try and get as close to PMF as possible. So then you have something that you can pour growth money onto and scale. But if you're reducing your runway because you're thinking that you're going to be giving up too much of that slice of the pie, then you're potentially cutting off your own nose. You're thinking too short term. This is a quick message to tell you about my company, Alpha AI. We built Lisa, the world's first AI-powered recruiter who screens candidates for you on autopilot. You can make your recruitment process 10 times faster, 90% lower cost, and significantly improve the candidate experience, all with our AI agent for hiring. Learn more at welovealpha.com or click the link below in the description. And now, back to the episode. Okay, so what if we went a little bit more tactical? Like let's look at pitch decks. You have read thousands of pitch decks, right? What's like a red flag which stops you from wanting to meet somebody? That was a great answer you gave there, which is in terms of the actual pitch, the actual conversation, the actual negotiations, the due diligence. But if we went step back a level, when it comes to the actual PDF, when hundreds of these land in your inbox, what makes you say no to wanting to meet somebody? What common mistakes are people making within the actual slides themselves?
Yeah, this is sort of like an orange flag to me, maybe not a red flag. But I think the biggest mistake you can make as a pre-seed or seed stage founder is burying the best information. When you're so early on, you don't always have 3x growth year over year and super exciting traction metrics yet. Maybe you do, but I can't tell you how many times I've been 15 slides, 20 slides into a pitch deck that I'm ready to give up on, and then all of a sudden we get to the end, and I'm like, holy shit, this is an amazing I can't believe they have these customers already, or something along those lines. And it just drives me crazy. And it's partially my own bias, which I'm aware of. I'm a washed up sales guy and sales leader. So to me, it's like, if you don't get your top selling points into the first 5 slides and the first 60 to 90 seconds of your elevator pitch, then you're probably not a great salesperson, and you're gonna have a hard time communicating with investors. You're gonna have a hard time communicating, to your customers. So I hate to call it a red flag, but get your best stuff. Be brutally honest with yourself about what is your edge, why somebody should take a shot on you, and then get that into the first 5 slides, however you can.
Yeah, and I'm with you. Like, I'm a salesperson. I was a recruiter for a decade. Like, when I'm angel investing now, like, usually if I'm 4 or 5 slides in and it hasn't got the hook and the attention, I don't actually look at the other slide because I've moved on to the next one. So, like, if your like North Star selling point is not right away at like right at the front, then like assume people aren't going to see it.
Exactly. It's hard. You have to be really honest with yourself, and kind of get out of the Shark Tank world of giving some, weird, weird long market update about, dynamics in the market. You can get to that after you hit your strongest points.
Yes. So Nick, you did an interview once where you said the asset you use most as a VC is emotional intelligence, knowing when to speak up, stay silent, or admit you don't know something, which I'll be honest, very few VCs probably live by that advice, but I agree. But why is it important? Like, why did you say that? Why did you believe that?
I joke, and I say this not to be obnoxious, but to make my point. I have a history in law degree from my undergrad. I've worked in startups for 15 years. I've built and sold a lot of software. I have 2 graduate finance degrees. I could have scrapped all of that and just gone to school and gotten a psychology degree and probably been a better VC right off the bat. So definitely an expensive and longer journey to where I ultimately wanted to go. But those are all useful skills as well. But it's, the reality is a dysfunctional investor base and or board can really tear a company apart, and make it dysfunctional and hard to scale. So I really believe that you need to have either a CEO who is COO, somebody who is super competent at kind of keeping everybody in line, getting everybody the information they need, but also 99% of the time, investors and board members make recommendations and CEOs make decisions. And I think sometimes investors forget that dynamic, forget that they're not in the CEO seat anymore or whatever. But I find when this goes wrong, companies can really get out of whack. And if the CEO is not great at it, then you need to have an investor board member around the table who, knows how to also keep other investors productive, but also in line a little bit, so you don't waste time on things that don't matter. And that takes a lot of trust and building trust and earning trust. Some founders get it very quickly. Some it takes more time. And I find if you overplay your hand on everything, or on things that don't matter, or on things you really don't know enough about to proclaim to be an expert about, it can be a killer. So you lose credibility very quickly, and you waste time. So I find that words matter. What you say, but also how you say it and when you say it, is one of the hardest things about early stage companies in particular, but certainly carries through all the way to later stage where you have more money, more ego, more voices around the table. So yeah, I stand behind that. I don't think I'll ever change my opinion on that. In fact, I probably feel that and believe it more every single day I'm in this industry.
Yeah, I have a lot of friends who are in venture who are like masters at reading an Excel, and they are good investors. And then I have friends who, I'll be honest, they like math really isn't their strong suit, but they are incredible with people, and they are phenomenal investors, and they have invested in some of the biggest deals of the past decade. And it's right, like a lot of this is a relationship game. Like if you can persuade, if you can influence, if you can build trust, if people like you and know you, then that's gonna be the unlock which allows you to really be successful in just all aspects of business, really.
Yeah, it's so interesting, and the other fun part, interesting part, and thing that I think as a former operator turned investor, I have to be aware of is a lot of things that I did in the beginning of my career in software back in the early 2000s. it's archaic now. It's dinosaur shit.
Sure. Yeah.
Some of it comes back and is relevant again in funny ways. So there's like, I guess underlying principles that I tend to keep in mind and use when thinking about commercialization and sales leadership and strategy for our companies now. But also, it's interesting and fun for me to be able to learn things from other companies and founders that maybe have a different sales cycle than I did personally, or have found a new way of marketing or getting the word out there that is also replicable to some of our other companies that are not competitive naturally, but just from a strategy perspective. It's fun because I get to sort of stay in the game that way and share ideas across the board. But I tend to, modulate my confidence in how I share information based on how important I think it is to the success of the company, or I guess if somebody is going to do something I think is a potentially catastrophic move, I have a pretty strong verbiage for that. But then there's other levels where I'll say, I'm 65% confident in this, or I'm 82% confident in this, just to make sure nobody over indexes on what I'm saying without doing their own thinking and research and other conversations. And it's one of those things I find a lot with my, with junior investors, with newer, younger founders. Sometimes VCs say things with a tremendous amount of confidence, whether deserved or not. And all of a sudden the founder or a team member will go off and start doing something where it's like,
sure.
To me, I'm like, oh God, I was just kind of thinking out loud. I wasn't saying this is the way things have to be. So I've learned to be very mindful of that, and only weigh in when I feel strongly about something, or modulate my answer when we're just sort of brainstorming, discussing ideas.
Okay. You once got some really great advice from your baseball coach. He said that you're never as good as you think you are, and you're never as bad as you think you are, which relates to the last point quite well. But how does this mindset shape you and the highs and lows of venture and entrepreneurship? Why is that stuck with you? Why is that important?
Well, being a baseball player through college baseball's it's a game of failure. If you fail 70% of the time, you're one of the best players, right? So that's a weird mindset to have as a human being. So you get really resilient, and it doesn't. There are times where I had, I was, 3 hits and 3 at bats in a game, and if I struck out to lose the game, nobody cared about the 3 hits I had earlier. And there were other days where I was 0 for 4. And if I got a hit to win the game, I was a hero. Nobody forgot about the 0 for 4 before it. Right. So you have to understand a lot of things in business and in venture, and in the world, you get perceived as like, what have you done for me lately? And in reality, the feedback loop, the time to success, the blips and successes along the way are very temporary, little parts of the journey. And if you if you only focus on the milestones, or well, I can use the term milestones, up or down, or if you don't take a little bit of time to celebrate the wins along the way, then you're probably not enjoying the journey. And you have to enjoy the journey, whether that's great wins or the really, really hard losses and conversations. And I apply that to business and being in the venture world. I probably apply that to life in a lot of ways also. But yeah, I think in a lot of ways, baseball has prepared me a lot for life and career in business and venture, probably even more so than some of the other things I mentioned before. So I rank psychology and then baseball as like the 2 things that prepare me most for career and venture.
It's so weird. I speak to so many people on the show who in their background, they were either very successful or active in like athletics, sports, or often video games. But there seems to be a psychological thing here with the respect that, like, in most of those areas, it's about failing your way to success. You're playing the game, you die over and over again, and then eventually you figure out the unlock and you win. And baseball is a perfect example. There's a lot of parallels there in terms of hitting a home run, and you know, most of the time you're going to strike out. Like, why do you think that is, that so many people that are really successful in business and investing also really were into some kind of sport or game when they were younger?
I think nearly everyone who plays a sport at a competitive level also has an obsessive brain.
Yeah.
And if you don't, you're just not going to make it. And you're never, you know, it's actually a hard way to live for a long time. It was literally hard to get excited and happy about things, because I always felt like, you know, there's somebody else out there, you know, up working harder than I was. And, you know, and I played college baseball, take that to the, you know, professional level. And I know a lot of guys who play professional sports. Like it's an incredible level of focus and commitment. But we all have obsessive brains. And, you know, it took me probably 10 years after college to learn this. Because I was like, you know, I was a pretty good athlete. My brain worked okay. So I was like, you know, I'll just, you know, if I don't end up in professional baseball, I'll just move on my life, start a career and you know, transition. It was not that easy. Like losing that structure, losing that obsession, drove me crazy for a long time. Not like I didn't know exactly how to be a normal person that didn't have an obsession. And I mean, I hate to say it, you know, I understand why a lot of guys I played with or other athletes end up either not knowing what to do outside of the sport. So they end up doing something there forever, which is totally fine. But just kind of, I think, limiting from a life experience thing.
Sure.
And you know, on the darker side of it, a lot of guys end up with, you know, addiction issues because they have to fill that obsessive void with something. So I was fortunate at some point I figured it out and you know, found this venture world and using my brain to be like as interesting and you know, more durable and sustainable than being a baseball player. Really compelling and, you know, obsessive. I spent years building the fund up from nothing. I didn't grow up with money. You know, I made a little bit of money in my operational career, enough to take the risk to start a fund. But there were a few years there where I, you know, didn't have an income and was living in Manhattan, and you know, I didn't really do anything else. Like I just worked on building differential, and it was awesome. I loved it, but not really sustainable for the long, you know, the long course of life and a career. So yeah, I think that's kind of a common attribute. Most people who play sports and, you know, get into the business world, venture, startups, whatever, you're just obsessed with what you're doing.
Yeah, I mean, you have to have that obsessive personality, because if you don't, somebody else that's competing in the same world, they will, and they will probably beat you, because like if you're working, you know, here and they're working like, you know, it's a little bit harder. You know, the way that these markets operate, especially for venture-backed businesses, it's not quite winner takes all, but it's winner takes most in most verticals. So like if you want to be, if you're happy being in 4th or 5th place, then fine, but that kind of means like 20th place when you look at like the actual way that these markets end up getting split up after a few years of maturity.
Totally. I heard Ken Griffin from Citadel say this once. He said, you know, their goal at building Citadel is they have to be top 3 in every category they go into, or else it's not worth going into. And he said, you know, who's the 3rd largest you know, computer manufacturer in the world? He's like, don't know, don't care. He's like, who's the 3rd largest hedge fund in the world? He's like, don't know, don't care. He's like, we can't fit into that bucket. And it was interesting, and I definitely still feel that pressure all the time, even as a, you know, quote unquote emerging manager in a 3rd fund. You know, we're still very much on the way up here, and it takes a long time, but that always sticks with me.
Nick, for people that have enjoyed this, founders, investors, if they want to learn more about you or the fund, what's sort of like the one place that you could direct them to right now? Would it be your LinkedIn, your X, the fund's website? Where should they go to?
Yeah, LinkedIn's good. I'm reasonably active on there. I don't do a whole lot on X these days. Our website's great, lots of information about us and the fund and our team. And yeah, you can always shoot me an email. It's just nick@differential.vc.
Amazing. Thank you, Nick.
Thanks, Alfie.
Thank you so much for watching. Make sure that you click the follow or subscribe button wherever you're watching, and I'll see you in the next episode.
Introducing Lisa, the world's first AI-powered recruiter. She's an AI agent who works 24/7, screening candidates on autopilot, conducting interviews in 30 different languages, uploading all the best candidates to your applicant tracking system. Hire 10 times faster at 90% lower cost and significantly improve the candidate experience. Visit welovealpha.com to start your free trial now.